Welcome back. We are returning for our monthly episode of Happy Half Hour. Toby Weber, I'm Nick Shermans. Today is Wednesday, October 16th. Toby, happy birthday.
Thank you very much. There's nothing I'd rather do on my birthday than a podcast.
I sense some sarcasm.
Maybe.
What's an ideal birthday for you at the tender age of, I won't say your age, but what's a birthday like for you at this point in your life?
Pretty uneventful. 54 years old today. I don't mind sharing that. Still young at heart. But we basically will do dinner with the family, hang out with the family, and that's about it. I might get a present or two, if that. Sometimes my wife and I don't even get each other anything because what more could we ask for than what we already have? So,
do you have a birthday dish that you enjoy?
I like Italian food, so we'll typically go out to an Italian restaurant. We actually did that last night because people were busy tonight. So we had a nice dinner last night with the entire family, and always great to catch up.
Awesome.
Hey, Nick, as you look at the market today, what piques your interest out there currently? We're at 5820 this morning on the S&P. Russell 2000 is kind of where it was 3 years ago. Gold's almost at 2,700. Bitcoin at 67,000. As you look at the landscape today, approaching election and year end, what catches your eye? What piques your interest?
This actually tees me up perfectly. And Toby and I don't talk before this. So there's been a lot of that kind of talk. Like markets have gone up. There's a lot of things to worry about. There's more downside risk than upside left. That's kind of the consensus out there, which could be true. I don't disagree with that. However, Bespoke Investment Group, which is one of our research partners, recently put out a study on recent bull markets. And I say recent, going back post-World War II up until now. And so I'm going to rattle some stuff off here. And again, I'm not saying this is going to explain what happens next, but I think it's important to understand history when you're talking about a lot of this stuff. So the current bull market turned 2 last weekend. So if you recall, the bottom was October 2022. 2 years later, 503 trading days later, this bull market is up 63%, which is pretty much in line with the average bull markets post-World War II, pretty much in line with the upside. And as I alluded to, this bull market is 503 trading days old. Only 3 of the 11 prior bull markets that lasted 2+ years, which 2024 would qualify, didn't go on to last at least another 2 years before ending. So I'll say that again. Only 3 of the 11 prior bull markets that lasted 2 years didn't go on to last at least another 2 years. So the trend is your friend. You know, I've said that a lot. It's tough to fight an upcurrent. And while many people think today's values are stretched, and you can certainly make that case, previous bull markets, the last 11 post-World War II, lasted another 2 years based on where we're currently at. Okay. On average, the S&P rallied another 85% from the 503rd trading day to the end of these prior 11 bull markets. So potentially, again, looking at history, up another 85% after the 2-year mark to the end of these previous 11 bull markets.
So that's great information. Obviously, the past is not necessarily a predictor of future results. What advice would you have for investors today based on where we're at? And, you know, there's a lot of, as you said, angst around the election that's coming up, a new president taking over, and what policies might follow there. So what advice would you have for investors in general as we navigate the next 3, 6, 12 months after, you know, what's been a pretty good run, 2023 and 2024?
A lot is racing through my head, but my advice would be corrections are part of investing. Difficult markets are part of investing. I feel like too many people view them as a bug in the system rather than a feature. Like you can't get 10 or 9% a year, which is what the market has averaged over the last 80 years, without the occasional dip. And I feel like more money is lost trying to prepare for the next crash and the next correction. So I think investors shouldn't try to time the top. When you look at history, gains often lead to more gains. And I think you certainly should do the work today to build a portfolio that mirrors the way that you feel about risk. You shouldn't be over your skis in AI stocks. You shouldn't be chasing the S&P 500. So be very mindful of risk. And like I said during the last podcast, the recent bout that we had in July is a really good time to kick the tires and see how much risk that you're taking. So to sum that all up, Don't view a correction as a bad thing. It's a necessary thing. It's part of investing. Markets going a little squirrely. That's perfectly normal. It gets old when people talk about, oh, markets are going crazy. It's like, that's just part of investing. Like, you shouldn't be a 100% equity investor if you can't handle the occasional 20% drawdown. Like, that is quite normal.
Yeah, and there's a couple of things that we talk about a lot and that we know for certain. And that is, at some point, there will be another correction. At some point, the market will go down, just as the market has gone up the last couple of years. But it's impossible to know the timing of that. And even if you had an idea of the timing, you really have to be right twice, reduce risk and catch the falling knife, and then figure out the right time to reinvest when the coast is clear and the market's going to go back up. And it's really almost impossible to do. And the other thing that we know is here at Pure, we have a framework for adjusting portfolios as the market conditions change. So if we do see the market starting to break down or starting to go in the wrong direction, we have a framework that we follow that will help us try to reduce risk and minimize the damage on the downside when that inevitably occurs.
This sentiment is everywhere. Like, there's an election coming up. The Middle East is on fire. The Russia-China problem, inflation, a slowing economy. A lot of people are asking, despite all these issues, how is the market doing what it's done the last 18 to 24 months? And my response is, there's not ever a period of time where markets flash green and say, nothing to worry about here. Everyone pile in. Let's just print money. There's always a myriad of issues facing the market. And I think as humans, we always look back at previous periods with fondness. Like, the 80s were great. The 90s were great. It's like, well, we only look back at those periods with fondness because we know they turned out okay. But the 80s had plenty of problems. We were on the brink of a nuclear war with Russia. There was a Cold War. There was an AIDS and drugs problem in this country. The 90s had healthcare reform and racial tension and domestic terrorism. Now we look back with fondness because we know the markets went up and things turned out okay. But to pretend like this period is the most unprecedented ever, I think it shows a lack of understanding of history. What do you think when you hear the term soft landing or hard landing, like when people pose that question?
Well, what it means to me is soft landing means that we don't have a significant severe recession and we don't have to go through that difficult period that the Fed adjusts monetary policy such that the economy slows, but it doesn't stop or go backwards as it would in a recession. And a hard landing would be the opposite, that they don't get it right with monetary policy. The economy slows more than they expect, and we get a bit of a hard landing where unemployment spikes and we have a recession. And those seem to be, two of the scenarios, along with the other one I've heard is no landing, which is we slow, but it's not even really a recession, and then we resume growth from there. So that's what I think about when I hear soft landing, hard landing.
I think that was an appropriate question, late 22, early 23. But inflation has gone down. The Fed has paused and now cut. Markets are at all-time highs. I think the plane has landed. I think we should move on to something else. It drives me nuts when I see people talking about this soft landing and hard landing. Sometimes I think the media just grabs on to catchy headlines and want to talk about it. But to me, it just doesn't make sense, and I kind of squirm when I hear that term.
Yeah, and here again, we know there's going to be another recession. The history is littered with them. They don't happen too often, but we know it's going to happen. We don't know the timing, but there's been people calling for a recession for 18 months, 2 years, in fact. So, I think it's kind of a fool's errand to try to predict when that recession is going to occur. We know it will. Hopefully the policymakers will respond appropriately, and hopefully we'll be able to adjust portfolios to minimize damage. But trying to predict when that's going to happen is a bit of a
and I think we both can say with confidence, it's been a rough go for those folks that are in the business of predicting recessions. They've had egg on their face, and they keep repeating the same narrative. And I'm not saying it can't happen, but I don't listen to people who are perpetually wrong and the same things over and over. Guess what percentage of the time the U.S. has been in recession the last 80 plus years? Close. It's like 9%.
10%.
So the stuff people keep predicting happens a lot less frequent than most people think. And then just looking at the glide path of recessions as our economy has gotten bigger and more mature and more stable, the recessions tend to be shallower, less intense, and last for a shorter period of time. If you look at recessions in the 20s and 30s and 40s, these were brutal, multi-year, even decade-long periods of stunted growth and depression. Now, as our economy is, as I said, grown and matured, it's just less intense. And then the last thing I'll say is when everyone is talking about a recession, it inherently makes it less risky, right? We have access to so much data. The flow of information is instant. And I think when a risk is known, it makes it less risky. You look back at the last 10 years, the stuff that really gets us is what no one is talking about, which is why, I always chuckle when someone asks me to, what's going to happen next? It's like, look, you can't make up the last 10 years. It's like a fairy tale. No.
Yeah, not a good fairy tale in some cases as well. So the last thing I'll say, and then we can move on, is, that's not to say that we couldn't have a recession in 2025 or 2026. We think it's kind of difficult to try to predict the timing of that and then be able to respond and avoid a drawdown, which, like you said, the reason we can enjoy years like we've had in 23 and 24 is because we are going to have drawdowns from time to time, and that's part of the
Well, and the best way to deal with that from an investment standpoint, there's two asset classes that really stand out as doing well during a shrinking of the economy. Care to take a gander at what those are? One is your favorite.
I would say gold would be one, and I would say fixed income
U.S. Treasuries,
would be
yes,
another
so bonds, but U.S. Treasuries tend to do really well when the stuff hits the fan. So gold and U.S. Treasuries, and we certainly own both in client portfolios. But I think the bigger thing, again, is building a portfolio that reflects the way someone feels about risk. A lot of investors think markets go down by 20%. We rush in and make a bunch of changes. That's horrible investing. Good investing is if you're a conservative investor, let's build a conservative portfolio. Market goes down by 25%, maybe your portfolio goes down 7 or 8 because we have gold and U.S. Treasuries and maybe only 30% equities or something like that, okay? On the other end, if you're an aggressive investor, we build an aggressive portfolio. Your portfolio goes down by 20% with the market. You fully understand the range of outcomes being a 100% equity investor. You accept those terms. That doesn't bother you. You keep investing and you stay the course. That's good investing. So there was one bull market that ended 13 days after the 2-year mark, and that was 1966 to 1968, okay? So not all bull markets, once they reach the 2-year mark, keep going higher. However, there's 2 bull markets that are most closely correlated to the one that we've experienced from 2022 to 2024. That is 1987 to 2000. That one was only 16% complete after the 2-year mark. So there was plenty of upside left from 1987 to 2000. And again, that was the one that is most closely correlated to the current one that we've experienced.
So if I understand what you're saying, we should expect markets to go up 80%
I'm saying
from here.
That once a bull market hits the 2-year mark, based on history, that is a favorable metric for future returns, despite the narrative out there that we're stretched and markets are topping out or what have you. Again, I could be wrong, and I'm not saying this is my viewpoint. This is just information from one of our partners.
No, it's good. It's good information. Always like to provide a balance.
Yeah, because what you send me, 95% of it is how things could get worse. Subconsciously, I'm trying to balance that out with how things could get better. And I think today, again, there's a lot of pessimism out there. It could be warranted. It might not be. But that's, like, personally, that's the most bullish case to me, is there's still people out there that are non-believers that think that this is all a house of cards. This is BS, and they might be right. But I'm a big fan of sentiment, and when you look at consumer sentiment, it's depressed relative to where we're at from a return standpoint in the stock market. When you look at investor sentiment, it's bullish, but it's not euphoric. So those 2 things are probably the biggest assets as it relates to the equity markets. And that's my personal opinion.
Yep. And I think that's part of the reason that you and I make a good partnership, because I tend to look at the world glass half empty and you tend to look at the world glass half full. And I think that we balance each other out in that way.
I read a quote that I really liked the other day, and I forget who it was, but they said, the past was not as good as you remember, the present is not as bad, and the future will be better than you expect. And I think that sums up my view of markets and my view of the world.
I like that. Okay, I have one for you. Let's drill down a little bit further. We typically will take an asset class and get your current perspective on it. So the asset class I wanted to have you comment on is fixed income, as we've started what appears to be a rate cut cycle. So how do you think about fixed income in client portfolios or fixed income generally, given where we're at today? Rates have come down a little bit, although since the rate cut, rates have actually backed up a little bit. So how do you think about fixed income in the current
So there's
scenario?
a couple things. One, fixed income finally has income. And I talked about this a lot, but fixed income over the last 10 years has really yielded nothing, meaning investors owned bonds with the hope that when equities went down, the bonds would maintain the value of the portfolio or mitigate downside risk. That turned out not to be true in 2022, and all sorts of squirrely things were happening then with higher rates and higher inflation. So I tend to discount that because that's more of an outlier than the norm. But back to my point, bonds finally have income. You could buy a one-year treasury and get around 4%. So that's really nice. Two, as the Fed has paused and started to cut, bonds are acting differently than stocks, which tends to happen when the Fed cuts. When the Fed is raising rates, most asset classes tend to move together. Stocks and bonds certainly move together, which doesn't do you any good, right? When rates and inflation are higher and your stocks and bonds are going down together. That's flipped when the Fed cuts rates. So fixed income is generating income. And then the other part, in a portfolio context, bonds are acting differently than stocks. So when stocks are down, bonds tend to go up. That's really what you want. And again, back to July and the early part of August, I think the S&P was down about 9% in a period of 10 to 14 days. And many of our multi-asset class portfolios, which include bonds and gold, experienced like 40% of that drawdown. And again, that's bonds acting differently, which is really what you want. So bonds are back, not only from an income standpoint, but as a risk reducer in the total portfolio context. And
Perfect.
last thing, I wrote about this all through 2022 and all through 2023 when investors were ready to sell their bonds and puke. Bond future returns are heavily influenced by current starting yield. Current starting yields are anywhere from 3.5% to 5.5% right now. So if you're building a portfolio and you're buying bonds with those yields, that's a rough expectation of what you can expect over the next 4 to 5 years on an annualized basis. Bonds track very closely to starting yield. Now, that doesn't mean you should go out and find the highest yielding bonds and buy those, because that is often a sign you're taking risk elsewhere, credit risk, rate risk, duration risk. So be very mindful of what you buy, but no, if you're buying investment grade bonds and, their current yields are 4%, that's likely what you're going to get over the life of the bond.
Yeah, I'm reading a really interesting book currently called How to Retire by Christine Benz. And she talks to a number of different folks about retirement, and they talk about fixed income, and people sometimes say, why do I own bonds in my portfolio? And the person described it as bonds buy you time. And I thought that was interesting. And the concept is you own stocks for the growth potential, the upside potential, but there are periods where stocks don't cooperate. And if you're in retirement, you need a portion of the portfolio that's going to be relatively steady. It's not going to hit a home run, but hopefully it's knocking singles and doubles on a consistent basis. And that fixed income part of your portfolio really buys you time until stocks kind of get back into a growth phase. So I thought that was an interesting way to phrase it.
Yeah, and there's a human psychology component to this as well. Like, people were wanting to sell their bonds at the time that they were the most attractive in a decade, right? So any asset class, when people start to throw hate at it or say, hey, why in the hell would I buy emerging market stocks or Chinese stocks or bonds? That's usually a time where I like to lean in and really kick the tires on something.
What is the biggest fear that you have, maybe irrational, but that you really don't like to talk about?
Well, the easy answer is something happening to my family. Like, that's the obvious, but you're talking about like something with my career.
Talk about you, something that really you worry about probably more than you should, but it's a fear that you have.
I worry about earthquakes. Like, the whole Florida thing kind of brought that to the fore, where they basically have a season where there's hurricanes and tornadoes and all these things, which can make you think the Northwest is the catbird seat as far as avoiding those types of events. But ours is coming, and I know you've gone down this rabbit hole, but at some point, we're not going to get a warning. There's going to be a mega earthquake. And, I used to think a lot of these preppers were crazy, but now that I have kids, I've grown older, I've started to create my own little prepper kit. And I'm actually going to Costco this weekend with my wife just to get some other things, because we've been putting this list together. We're almost done with it. So the unfortunate storms in Florida really kind of propelled us forward on this. Same question for you.
Yeah, I think earthquake is one, although I don't think I spend a lot of
No.
time sitting at my desk or sitting in my easy chair and think, I wonder if the earthquake will hit tonight. For me, and this is maybe from growing up, but I've always had this irrational fear of getting locked into something, locked somewhere. One time I was at a basketball camp and I went down, I had to use the bathrooms. I went down the stairs, I went through this door and I went to the bathroom, came back with the door and locked behind me. And I don't know, it just freaked me out. And so I've always had this irrational fear that I'm going to get locked somewhere and nobody's going to be able to hear me or find me. So there you go.
I don't know if that's
Irrational fear.
irrational. I mean, no one wants to get locked and left for dead. And certainly that experience had an effect on you.
So there, it did. I always check the door before I go through one, but we have cell phones now. So
I do have an irrational fear now that you're talking. So I cross the I-5 bridge. So I work in Lake Oswego. I live in Camas. So not every day, but 2 to 3 times a week, I cross that bridge twice, the I-5 bridge. And for those of you that don't cross that bridge or not from the Northwest, this bridge was built for horses and buggies. It's structurally obsolete. It's got like humps in it. It's an eyesore. It's horrendous. I think they're finally going to fix the problem, but it's been 25 years in the making. Hundreds of millions of dollars have gone into this and nothing has happened. My fear is that thing collapsing when I'm on it. It's not a stretch to say that. So every time that I go on it, either coming home or going to work, I roll down both of the windows. And my thinking is, if this baby comes down, I'm unbuckling my seatbelt, jumping out the window. Now, I'll probably get killed by other cars and steal from the bridge or what have you. But my irrational thinking is I'm going to jump out and swim to safety, which is completely ridiculous. But that's my deal.
I knew there was an irrational fear that you're grappling with periodically, and now we know. I don't think that's that irrational. It could happen, and you've thought it through, and you have a game plan for how you'll
But I look like
react.
a complete idiot because at 5:45, it's pitch black out, it's raining, and I'm driving with both of my windows down, and I'm sitting there ready for this thing to go down, and I'm just going to jump out and swim to safety in the pitch black. Like I'm going to drown, I'm going to get hit by a piece of steel, but that makes me feel better.
I like it. The last thing I wanted to mention before we wrap up is the new estate planning partnership that we signed up. I don't think we've talked about that. I know Aaron has a separate podcast that goes into estate planning for Pure Portfolios, but we've initiated a partnership with a company that does an online version of estate planning. It's called eStately. And check out the podcast that Aaron did that kind of goes into a lot more detail on it. But we're excited for folks that haven't done any estate planning or maybe have thought about the subject but haven't gotten it done. It's another avenue for people to think about and do their estate planning, and we're excited about that partnership with eStately.
That's all good stuff. All right, that wraps up a happy half hour with Toby and Nick. We'll see you again next month. Thanks for watching. See you next time. Bye-bye.